The 2008 financial crisis. The housing market bubble that contributed to the crisis began in the late 1990s and early 2000s, fueled by low interest rates and relaxed lending standards. As a result, many people were able to obtain mortgages that they could not afford to pay back. In addition, many lenders offered adjustable-rate mortgages, ARMs, that initially had low interest rates but would adjust upward after a few years. This meant that many homeowners found themselves unable to make their mortgage payments when their interest rates reset. Banks and other financial institutions saw an opportunity to profit from the housing market boom by creating complex financial instruments that were based on mortgages and other debts. These instruments, including mortgage-backed securities and collateralized debt obligations, were packaged together and sold to investors as safe investments with high returns. However, the underlying mortgages and other debts that backed these instruments were often of poor quality, and many borrowers defaulted on their loans when the housing market began to decline. This caused the value of mortgage-backed securities and other financial instruments to plummet, resulting in significant losses for investors. The crisis also exposed weaknesses in the regulatory systems that were supposed to prevent or mitigate such risks. In particular, the U.S. Securities and Exchange Commission, SEC, failed to adequately regulate the financial institutions that were creating and selling these complex financial instruments. The crisis had a significant impact on the global economy, causing a recession that lasted from December 2007 to June 2009 in the United States, and longer in other countries. The crisis led to widespread job losses, as many companies were forced to lay off workers or go out of business. It also led to a number of high-profile bank failures, including Lehman Brothers, which declared bankruptcy in September 2008. In response to the crisis, governments around the world implemented various policies to try to stabilize their economies. For example, the US government provided bailouts to some of the largest financial institutions in the country, including Bank of America, Citigroup, and AIG. In addition, the US Federal Reserve and other central banks around the world lowered interest rates and implemented other measures to provide liquidity to the financial system. The crisis also led to major reforms in the financial sector. In 2010, the US Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, which aimed to strengthen financial regulations and prevent a similar crisis from occurring in the future. Among other things, the law created the Consumer Financial Protection Bureau, which is responsible for protecting consumers from unfair or abusive financial practices. Here are a few more points about the 2008 financial crisis. 1. The crisis had a global impact. While the crisis originated in the United States, it quickly spread to other countries around the world. This was due in part to the fact that many of the complex financial instruments that contributed to the crisis were sold to investors in other countries. 2. The crisis led to a wave of foreclosures. When homeowners were unable to pay their mortgages, banks foreclosed on their homes. This caused a significant decline in housing prices and a loss of wealth for many people. 3. The crisis had a disproportionate impact on marginalized communities. Many low-income and minority borrowers were sold subprime mortgages with high interest rates and unfavorable terms. These borrowers were more likely to default on their loans and suffer the consequences of foreclosure. 4. The crisis highlighted the dangers of too-big-to-fail institutions. Some of the largest financial institutions in the world, including Lehman Brothers and AIG, were deemed too big to fail. This meant that the government felt compelled to bail them out in order to prevent the entire financial system from collapsing. 5. The crisis resulted in significant changes to the financial industry. In addition to the Dodd-Frank Wall Street Reform and Consumer Protection Act, which aimed to strengthen financial regulations, the crisis also led to increased scrutiny of the financial industry and a greater emphasis on transparency and accountability. 6. The crisis had a lasting impact on public trust in the financial industry. Many people became disillusioned with the financial industry and its role in the crisis. This led to a greater emphasis on consumer protection and a renewed focus on ethical and responsible behavior within the industry. Thanks for watching.